Imagine it's September 12, 2008. You're a 53-year-old electrical engineer living in Lehigh Valley, Pennsylvania. You've worked at the same manufacturing firm for 19 years. You earn a respectable salary. You own a 3-bedroom home you bought back in 1997 with a conventional 30-year mortgage, the kind of boring, responsible financing that middle-class America used to treat like a moral virtue. Your wife teaches 4th grade at the local elementary school. Your oldest daughter just started her sophomore year at Penn State. You've been contributing to your 401k every pay period since 1994. You didn't speculate. You didn't flip houses. You didn't buy securities you couldn't explain at the dinner table. You followed the formula the post-war American economy handed you. Work hard, save consistently. Trust the system. Then September 15th arrives. Lehman Brothers files for bankruptcy, $639 billion in assets, gone. The largest bankruptcy filing in U.S. history. And suddenly the world you built your life inside of starts cracking like ice. Within 6 weeks, your 401k is down almost 40%. Within 4 months, your company announces layoffs. Within 6 months, you're one of them. Within a year, the equity in your home has dropped by nearly 40%. The house you bought for $160,000 is now appraised below what you still owe. You did nothing wrong. You changed nothing. You made no reckless decision. But the system that promised stability had been decaying long before that Monday in September. Lehman wasn't the beginning. Lehman was the moment the floor finally gave way. The rot was already in the beams. And the most unsettling part is this: it was visible. Not in secret memos. Not in conspiracy forums. In published data. There were 3 specific, measurable warning signs visible years before the collapse, structurally identical signs that appeared before the Great Depression of 1929. Before Japan's lost decade began in 1991, before the Asian financial crisis in 1997, before the slow unraveling of Britain's economic dominance, before Spain's imperial finances buckled centuries earlier. Different eras, different currencies, different institutions. Same sequence, because collapses don't happen the way people imagine. Most people think an economic collapse is a sudden event, a stock market crash, a bank failure, a headline that changes everything overnight. They imagine an earthquake, unpredictable, violent, instantaneous. That is the popular myth. But an economic collapse isn't an earthquake. It's a bridge losing structural integrity for years, carrying increasing weight while inspection reports are ignored, softened, or rewritten. The collapse is the moment the bridge fails. But the failure was decided long before the moment the public sees it. The most dangerous phase of any economy is not the crisis. It's the period immediately before the crisis, when all visible indicators suggest stability. Asset prices are rising. Employment looks fine. Credit is abundant. Anyone questioning the health of the system is dismissed as a pessimist who doesn't understand how the modern economy works. That period has a name in every post-collapse autopsy: the blow-off top. The final acceleration. The last surge of confidence before the structure gives way. And the blow-off top is produced by the same 3 warning signs every single time. Once you see them, you cannot unsee them. Because they don't look like danger. They look like prosperity. So here's the promise of this video. We're going to map the architecture of failure not through vague doom. Not through hot takes, but through a structural pattern that repeats with almost cruel reliability. We'll break down the 3 warning signs in the same order history delivers them. Credit growth detaches from real, productive output. Asset prices detach from underlying economic reality. Financial prosperity diverges from broad economic health. It's concentrating gains and hollowing out the base. Fragility, illusion, concentration. Different names, same mechanism. And by the time the average person notices, the system has already answered the most important question. Not if, but how. In the next section, we'll start with the first warning sign, the one that always arrives first. The one that looks like expansion and opportunity. Credit growth outrunning the real economy. Because when debt expands faster than the income required to service it, you are not creating prosperity. You are borrowing it from the future. And the future always sends a bill. The first warning sign before every collapse is not a headline. It's a relationship. A quiet decoupling that most people never notice because it hides inside good news. Credit. Growth begins expanding significantly faster than productive output growth. Debt grows faster than the economy's ability to carry it. And once that gap opens and persists for years, the system becomes structurally distorted in a way that does not self-correct. Here is how it works mechanically. In a healthy economy, credit has a job. A business borrows money to build a factory. The factory produces goods. The goods generate revenue. The revenue services the debt, pays the workers, and produces profit. The credit created something real. The loan justified its own existence. This is productive credit, the kind that expands future capacity. But credit can also do something else. Skin buy existing assets instead of creating new ones. Can fund speculation on price appreciation. It can fund consumption that generates no future income. It can refinance previous obligations that also produce no new productive capacity. In all of those cases, the debt is created, the obligation is real, the interest must be paid. But nothing new is built that makes repayment easier. That is unproductive credit. And when unproductive credit begins growing faster than productive output, the system starts borrowing against itself. The economy's debt burden rises faster than its income base. More and more of economic activity becomes debt service rather than value creation. And that is not a theory. It's an accounting identity. If debt grows at 7% per year while GDP grows at 2% per year, the ratio between the two expands relentlessly. It doesn't matter how optimistic the news sounds. Doesn't matter how high the stock market goes. The pressure is accumulating. The question is never whether that is sustainable. It isn't. The question is how long it persists before correction arrives. History shows the pattern in clinical clarity. The United States, 1920 to 1929. Prosperity built on borrowed acceleration during the 1920s. Private debt in the United States expanded rapidly, while real GDP grew at a much slower pace. The gap widened year after year. And where did that excess credit go? It didn't go primarily into building new productive capacity. It flowed into speculation and consumer installment lending. Broker loans money lent to investors to buy stocks on margins surged to levels that were unprecedented relative to the economy. Meanwhile, consumer installment debt exploded as households bought cars, appliances, and furniture on credit. On the surface, the 1920s looked like the modern age arriving. Industrial production rose. Employment appeared strong. The stock market hit new highs. The surface indicators looked healthy. But the productive economy was not growing fast enough to support the obligations being built above it. Credit was inflating asset prices and pulling forward consumer demand rather than expanding real productive capacity proportionally. So when the correction arrived in late 1929, it didn't destroy a healthy system. It revealed a system that had been structurally unsound for years. The crash was the X-ray. The disease was already advanced. Japan, 1985 to 1991. Cheap credit and the illusion of permanent wealth now jump to Japan. After the Plaza Accord in 1985, Japan faced a sharply strengthening yen. To offset the contractionary effects and protect growth, the Bank of Japan lowered interest rates aggressively. Cheap credit flooded the system. Bank lending surged far faster than real GDP. But again, where did the credit go? Not primarily into productivity breakthroughs or new export factories. It flooded into real estate speculation and stock market investment. By the peak, Japan's asset valuations became legendary for their absurdity. Land in Tokyo priced as if it were a finite substance more valuable than the rest of the world combined. The Nikkei soared, not because productivity doubled, but because credit did. And then the moment the Bank of Japan tightened, the credit engine stalled. Asset prices fell and kept falling. Japan's lost decade wasn't caused by one sudden external shock. It was the consequence of years when credit growth outran real productive output. The boom was the warning. The crash was the consequence. The United States again. 1997 to 2007, the hidden decade of structural deterioration. Now return to America in the decade before 2008. Household debt surged dramatically, mortgage debt especially, but real median household income barely moved. Credit was expanding at multiples of income growth. And the credit was not building productive capacity. It was financing home purchases at disconnected prices, consumption on borrowed money, and a financial sector that increasingly produced instruments rather than goods. The financial sector doubled its share of the economy over decades, not by making physical products, but by making paper claims. Mortgage-backed securities, collateralized debt obligations, credit default swaps. Each layer of complexity generated fees, profits, bonuses. But it did not add productive capacity. It was credit creating the appearance of wealth without the substance of it. The pattern repeats because it feels good while it's happening. Unproductive credit makes the present feel richer. It brings consumption forward. It pushes asset prices upward. It creates jobs connected to asset, booms construction, brokerage, finance, retail spending. And those jobs create the illusion of broad stability. But the obligations are real. The interest is real. The principal is real. And the income required to service them is not growing fast enough to match. That's why this warning sign always comes first. It's the foundational imbalance. Once credit growth detaches from productive output, the system begins compensating. It must create something that makes the debt look safe. That something is usually asset inflation. Because when debt is abundant, it flows into the easiest target, assets. And that brings us to warning sign number 2. In the next section, we'll follow the credit into its destination: stocks, housing, bonds, real estate, commodities, whatever can absorb excess liquidity. We'll break down how asset prices detach from underlying income and earnings, why bubbles aren't just high prices, but dependence on continuous credit expansion, and why every bubble invents the same story. This time is different. It never is. Once credit growth outruns the real economy, that excess credit has to go somewhere. It doesn't distribute evenly through society like rainfall. It concentrates. And where it concentrates tells you where the eventual collapse will begin. This is the second warning sign. Asset prices detach from underlying economic reality. Stocks rise faster than earnings. Homes rise faster than incomes and rents. Commercial real estate rises faster than cash flow. Bond prices rise until yields become a fantasy. A gap opens between price and value. And in moderate amounts, that gap is normal. Markets are forward-looking. Optimism is a feature. People price in growth. They price in innovation. They price in the future. But when valuation premiums expand to extreme levels across entire asset classes, something structural has shifted. Prices stop reflecting future productivity. Prices start reflecting the volume of credit chasing assets. The asset is no longer priced by what it produces. It is priced by what it can absorb. This is the real meaning of a bubble. And the word bubble, the way people use it, actually hides the danger. It makes it sound like a temporary overpricing that will deflate gently. But bubbles don't deflate gently. A bubble is a period when the price of an asset becomes dependent on continuous credit expansion to sustain itself. The price is supported by flow, not by value. So if credit growth slows, the price becomes unstable. If credit contracts, the price doesn't decline. It collapses, because the floor wasn't there. It was being held up by borrowed money. Let's watch the pattern repeat across history like a ritual. The United States, 1929, the loop of margin, euphoria, and forced selling in the late 1920s. Stocks surged far faster than corporate earnings could justify. The Dow rose sharply in the final years. Price-to-earnings multiples expanded beyond what the era had seen before. And the mechanism that supported these prices was not productivity alone. It was margin lending. Investors borrowed money to buy stocks, using the stocks as collateral. As prices rose, their collateral value rose, allowing more borrowing, which allowed more buying, which pushed prices higher. Circular, self-reinforcing. A structure that required constant inflow to stay upright. Then, confidence wavered. It always does. And the moment it wavered, the credit structure turned against itself. Margin calls began. Investors were forced to sell to meet obligations. Selling pushed prices down, which triggered more margin calls, which forced more selling. A feedback loop. That is what leverage does. It turns small declines into cascades. The Dow fell nearly 90% from peak to trough, and it took decades to return. The crash did not cause the Great Depression on its own. It revealed that the market had become structurally dependent on credit expansion to sustain valuations. The prosperity had been an illusion built on leverage. Japan, 1989. Wealth priced as if land were sacred. Japan's late 1980s bubble is often described as an anomaly. It wasn't. It was the same mechanism with different cultural wallpaper. Cheap credit poured into assets. Stocks were priced at multiples that made the long-term average look like a joke. Real estate values in Tokyo reached absurd levels, so absurd they became global mythology. The famous comparison Imperial Palace land valued more than all the real estate in California wasn't a punchline. It was a warning flare. Rental yields implied by those prices were tiny. The assets didn't produce income that justified their valuation. So why did people buy? Because they believed the credit engine would continue. It's because everyone believed the price would keep rising. That's what bubbles do. They replace analysis with momentum. When the Bank of Japan tightened and credit slowed, prices lost their support. And because prices were based on flow, not value, there was no floor. They fell for years. Banks that had lent against inflated collateral suddenly held liabilities backed by evaporating value. Their balance sheets rotted slowly, and the country spent decades in stagnation trying to manage the aftermath. Again, the boom was the warning. The bust was the consequence. The United States, 2006, housing priced beyond income. Stocks priced by the same credit machine. Now consider America in the 2000s. Home prices rose far faster than wages. Price-to-income ratios widened. Price-to-rent ratios widened. In certain metro areas, home prices doubled or tripled while incomes barely moved. The asset wasn't being priced as shelter. It was being priced as a levered investment. And the financial sector manufactured the fuel. Mortgage products expanded. Standards fell. Securitization allowed risk to be distributed until everyone believed no one was responsible. But here's the structural irony. The stock market's apparent strength was partly supported by the same credit machine inflating housing. Financial sector profits surged fees from securitization, trading, derivatives, servicing. Those profits made earnings look strong, which made stock valuations feel justified. So the system became self-referential. Profits depended on lending. Lending depended on asset prices. Asset prices depended on lending. Remove any piece and the structure collapses. That is the essence of warning sign number 2. Asset prices detached from value across multiple classes simultaneously. And the detachment was explained away by narratives. Every bubble invents the same story. This time is different. Here's the part that makes this pattern so durable. Every bubble has a narrative. In 1929, a new era of industrial productivity. In Japan, superior management and a unique corporate structure. In 2006, financial innovation reduced risk and securitization made the system safe. In every case, the narrative performs the same function. It provides intellectual cover for valuations that have already left reality. The narrative isn't the cause. Credit expansion is the cause. The narrative is the immune suppressant. It neutralizes doubt, stops the system from correcting itself early. Because early correction would hurt while everyone still feels fine. So warning sign number 2 is not hidden. It is visible in data. Price-to-earnings ratios. Price-to-income. Price-to-earn cyclically adjusted valuations. Yield compression. These are not obscure metrics. Professionals see them. Analysts discuss them. But in the blow-off top phase, they are always explained away. And here's why this is a warning sign of collapse, not just overpricing. When asset prices depend on credit expansion, the system becomes fragile, becomes a bridge held up by flow. The moment credit tightens, even slightly, prices wobble. And when prices wobble, leverage magnifies the fall. But there is still one more warning sign. Because credit expansion and asset inflation don't benefit everyone equally. They concentrate gains among those who already own the assets being inflated. Meanwhile, the productive economy, the one most people live in, stagnates. That divergence is not just unfair. It is destabilizing. It is warning sign number 3. In the next section, we'll examine the final pre-collapse pattern. The split economy: financial prosperity at the top, wage stagnation and rising essentials below, and the moment when the majority begins using debt to simulate income growth. Because when the base weakens, the structure becomes brittle. And brittle systems don't bend, they break. The third warning sign is the most politically explosive one because it's the only one you can feel without a spreadsheet. It's the moment the economy splits into two realities. One reality is measured by markets, stock indices, corporate earnings, aggregate GDP, asset values. This reality can look fantastic. It produces headlines that sound like victory. It makes the system look stable, sometimes even strong. The other reality is lived by the broad population. Wages that don't keep pace, jobs that feel less secure, costs of essentials rising faster than incomes, and a growing reliance on credit just to maintain a standard of living previous generations reached through income alone. When those two realities diverge, you get a diagnostic symptom that appears in every pre-collapse era. Financial prosperity rises while broad economic health stagnates. And that divergence doesn't just produce resentment, it produces fragility. Because an economy can survive inequality for a long time, but it cannot survive when the majority loses the ability to sustain demand without borrowing. That's the mechanical failure point, because the majority is the demand base. The majority buys the goods, pays the rent, keeps businesses running. When their income base stagnates, the system has two choices: either accept slower growth or replace missing income growth with credit. Modern economies almost always choose credit because credit preserves the illusion of stability, until it doesn't. Let's watch this pattern again through history. The United States, late 1920s, booming profits, stagnant workers. In the final years before the Great Depression, corporate profits were strong. Markets were euphoric, and surface indicators looked healthy. But real wages for many industrial workers were relatively flat. Agricultural incomes had been declining for years. Rural America didn't share in the boom the way the stock market did. Income inequality reached extreme levels. Wealth piled up in financial assets and urban real estate. The broad population, especially those outside the asset-owning class, didn't participate proportionally. So when the downturn hit, the majority had no buffer, no savings, no asset cushion, no ability to maintain consumption. Demand collapsed quickly, and a recession deepened into a depression. Here is the structural lesson. The breadth of prosperity determines the depth of the fall. An economy that concentrates gains at the top becomes brittle at the base. When the base breaks, everything above it loses support. The United States, 2000 to 2008, asset owners soar, incomes flatline. Credit fills the gap, now jump to America before 2008. Corporate profits rose, markets were strong, aggregate GDP looked stable. But real median household income was flat for years. The cost of essentials, especially housing, healthcare, education, rose faster than wages. So how did consumption remain strong? Credit, mortgage extraction, home equity lines, refinancing, debt masquerading as income. This is where the system becomes dangerous. Credit is used not to build capacity, but to simulate living standards. And the people who are pulled into this last are always the most vulnerable. Subprime borrowers, first-time buyers, communities targeted by predatory lending, workers whose jobs exist only because the bubble creates demand, construction, real estate services, mortgage brokers. When the bubble ends, the losses cascade upward, but the first blood comes from the bottom. And after the crash, the recovery often becomes another chapter of concentration. Those with liquidity buy distressed assets cheap. Those without liquidity lose homes, savings, stability. The crisis becomes an opportunity for capital consolidation. That's why the divergence is not incidental. It is causal. The modern version of warning sign number 3, headline stability built on household stress. This is the part that fools people. Because the divergence can coexist with good news. Markets can hit record highs even while households struggle. Unemployment can look low even while jobs become less secure and benefits shrink. GDP can rise even while the purchasing power of the median worker erodes. That is why this warning sign is the most misunderstood. People assume markets reflect broad health. Oh, they don't. Markets reflect asset valuations. And asset valuations can rise even while the broad economy is hollowed out, especially when central banks and credit expansion support asset prices. So the divergence becomes a feedback loop. Credit expansion inflates assets. Asset inflation enriches asset owners. The majority doesn't experience proportional income growth. To maintain consumption, the majority borrows. Borrowing increases debt burden faster than output. That widens warning sign number 1 again. Fragility feeds itself. The system accelerates toward failure not because anyone intends it, but because every local incentive pushes toward the next step. The mortgage broker approves the loan because commissions depend on volume. The bank packages the loans because the market demands the product and profits are immediate. The central bank stays loose because the system looks stable and tightening risks political backlash. The buyer takes the loan because home prices are rising and the alternative is being priced out forever. Each actor behaves rationally in their local context. No one behaves rationally in the systemic context. And no one has incentive to protect the system as a whole. That is the trap. Now here's the point where the 3 warning signs come together as one machine. Credit grows faster than productive output. Excess credit inflates asset prices beyond value. Gains concentrate while the broad base stagnates, forcing more credit use. Fragility, illusion, concentration. They feed each other. And once the loop is established, there are only 3 ways it can resolve. Controlled deflation, slowly reduce credit, and let prices adjust over years. Theoretically, ideal. Politically, impossible. Too much pain early. Disorderly crash, panic, defaults, recession, unemployment. The sudden release of accumulated pressure. Inflate it away. Suppress rates, print liquidity, transfer cost through currency debasement. This buys time, but turns the imbalance into a currency problem, punishing savers. None are painless. None spare the middle. And here's the final historical irony. After every collapse, the system reforms. Regulations are passed. Commissions are formed. Lessons are declared learned. And within 1 generation, the same 3 warning signs appear again, because the political pressures that drive them never disappear. The demand for growth, the fear of unemployment, the lobbying power of finance, the public expectation that homes and retirement accounts will rise forever. So the pattern returns, like a river returning to its channel. Which brings us to the final question. If the warning signs repeat, what is the point of seeing them? The point is not to predict timing. Timing is unknowable. The point is to recognize structure. Because the people who pay the highest price are rarely the reckless. They are often the ones who trusted the system most deeply, the savers, the planners, the middle. They are punished not for speculation, but for believing the bridge was sound. In the next section, we'll close with the full pattern as an autopsy. How these 3 warning signs always appear in the same sequence. Why they look like prosperity, and why the next collapse is never announced until after the floor gives way. Because by the time the public begins asking if the structure is stable, the structure has already provided its answer. Here's what history teaches, over and over, with a kind of cold patience. Economic collapses are not surprises, they're recognitions. The system doesn't suddenly break. It gradually loses integrity while appearing stable. The collapse is the moment the public is forced to see what was already true. That's why Lehman felt like an earthquake in 2008. But it wasn't an earthquake. It was the bridge finally snapping after years of invisible stress fractures. And those stress fractures were not mysterious. They followed a sequence, the same sequence that appeared before 1929, before 1991 in Japan, before 1997 in Asia, before every major debt-driven unwind that gets remembered as a once-in-a-lifetime event, right up until the next once-in-a-lifetime event arrives. The 3 warning signs are always the same. Warning sign number 1. Credit outruns productive capacity. Debt grows faster than the real economy. The system accumulates obligations faster than it accumulates income. This doesn't feel like danger at first. It feels like access. It feels like opportunity. It feels like growth. Because credit makes the present bigger. It pulls consumption forward. It keeps businesses alive. It keeps unemployment lower than it would otherwise be. But it also builds a future bill, and the bill compounds. Warning sign number 2. Asset prices detach from value. Excess credit concentrates into assets. Stocks, housing, bonds, real estate prices rise faster than the cash flows they're supposed to represent. Valuations expand because money is chasing returns. The price becomes dependent on the continuation of credit. And that's what makes a bubble lethal. The day credit slows, the price has no floor. The asset wasn't expensive because it was valuable. It was expensive because it was liquid. Warning sign number 3. The split economy forms, the gains concentrate. The asset owners feel richer. Markets look healthy. Headlines celebrate prosperity. But wages stagnate. Essentials rise. The majority borrows to simulate income growth. And that borrowing feeds back into warning sign number 1. The base of the economy becomes fragile because demand is no longer supported by rising incomes. It's supported by borrowing. Fragility, illusion, concentration. A loop. Now, here is the part that makes this pattern so cruel. Each warning sign looks like prosperity. Its credit expansion looks like help. Asset booms look like wealth creation. Rising markets look like health. And the split economy can be hidden behind aggregate statistics for a long time. That's why the majority misses the signs. Not because the signs are concealed. Because the signs are marketed as success. And because the system rewards anyone who goes along with the narrative until the moment it cannot. Every bubble invents the same story. This time is different. 1929, new industrial era. Japan, unique corporate system. 2006, innovation eliminated risk. Today, new paradigms, new technology, new policy tools. The story changes. The mechanism doesn't. Now, at the end of every cycle, the system faces 3 possible exits: controlled deflation, slow deleveraging, lower asset prices, pain spread over years. Theoretically, ideal. Almost never tolerated politically. Disorderly correction, panic, defaults, credit freeze, unemployment. What happens when option 1 is avoided too long? Inflationary escape print, suppress rates, erode death through currency dilution. This avoids immediate collapse but transfers pain through purchasing power loss. All 3 are forms of payment. The question is never whether the bill will be paid. The bill is always paid. The question is who pays it and how. And in modern credit economies, the pattern is painfully consistent. The people who pay the highest price are not always the reckless. They are often the ones who trusted the system most. The savers. The planners. The middle. The ones who believed the bridge was sound because the officials said it was sound and the traffic was flowing. They are punished for trust. Meanwhile, those with liquidity, access, and flexibility tend to recover fastest. They buy the distressed assets. They acquire the cheap wreckage. They turn crisis into consolidation. This isn't cynicism. It's the documented distribution of outcomes in every major unwind. So what do you do with this? The point is not to predict the exact date of the next collapse. Timing is the one variable history refuses to reveal cleanly. Systems can stay unstable longer than logic suggests until they can't. The point is to see structure. To recognize the sequence. To understand that when you see credit accelerating faster than output, valuations expanding beyond cash flows, and a widening divergence between markets and median life. You are not watching prosperity. You are watching pressure accumulate. Okay, once you understand that, you stop being surprised by the headlines. Okay, you stop being hypnotized by the blow off top. You start reading the system like an engineer reads a failing bridge, not by whether it looks fine today, but by whether its load-bearing math still holds. This analysis is historical and educational. It is not financial advice, but literacy matters, because the patterns don't wait for permission, and neither should your understanding.